Hey everyone, welcome back to the Kuderna podcast. I'm your host, Bryan Kuderna. So this is one of those in-between episodes. If you're not a regular listener or viewer of the show here, typically I'm having a variety of guests on the show in which we discuss everything from health to wealth, sports, economics, business, pretty much anything that I think is cool and that I hope you would as well. But in between, I put on my kind of day job hat as a financial advisor and provide some of the insights as to what I'm talking with clients about every day and my thoughts on the markets, the economy, everything that's kind of spinning around in the world at the moment. And that's what I'm going to do in today's episode. So I'm always getting questions about tax planning, and while I'm not an accountant, I will preface with that. I'm not a CPA. If you haven't met me or listened to me yet, I'm a CFP, which is a certified financial planner. So I'm more looking at things from a macro standpoint of how to manage your money, your investments, your insurance, the household budget, the business planning, et cetera. And all of that certainly with a tax angle, but I am not a tax preparer. So my viewpoint is a little more broad, I believe, when it comes to the tax side of things. With that said, I get so many questions, and a lot of it comes from a confusion of how exactly does the tax code work, here and now in 2026, and where have we come from? How did this enormous, if you ever look at the tax code, if you think a dictionary is big, multiply that by like 15, and that's what we're dealing with the U.S. tax code. So this didn't happen overnight, and that's what I'm going to do in today's episode. We're going to look back at the history of U.S. taxation. And I know you're like, oh my gosh, this is going to be boring, but I'm going to boil it down. So this is kind of like the cliff notes of the key points that I really think every American taxpayer ought to be familiar with. And that's what got us to the situation we're in today. And then I think that'll give us a good vantage point looking forward of, well, what's the tax climate going to be 10 years from today when I'm putting kids through college, when I'm retiring, maybe when I'm passing on and leaving a legacy, all these different milestones of life. What might Uncle Sam mean to me at that point in time? Okay. So just to give you a little context, I'll walk you through the history from the very beginning, and then we're going to close out today's episode with kind of a little bonus material or bonus round on the Roth IRA. If you've listened to me, if you've read my books, any of that stuff, I'm quite a big proponent of the Roth option. You hear me say things like swallow your medicine today and then you're home free. A lot of those different lines of kind of the short-term pain for the long-term gain, those really come to light when we talk about the Roth IRA, Roth 401k, pretty much anywhere you hear that word Roth, that's what I'm talking about. And I think as we go through today's conversation, which will be a bit of a monologue, obviously, I think it's going to really shine some light on why is the Roth good? Maybe not for everybody, but where are its strengths and where can you utilize it within your own financial plan?
Is going to require work and time and sweat and toil.
If money wasn't an issue, what would I be doing?
Don't worry about it. You'll figure it out.
Change is the only constant.
The Kuderna Podcast.
So like I promised, let's go to the very beginning. So this is going to come to a shock to some that if you could believe it or not, in our country's history, for about half of American history thus far, there was no income tax. Hard to believe when you fast forward to today, 2026, and income tax is the largest source of revenue to the U.S. government. But that fateful day, that happened in 1913 with the passage of the 16th Amendment. And what that gave the federal government the ability to do is to tax U.S. citizens and companies without an apportionment to states, meaning that that tax revenue did not have to go back to the states. That was the actual federal government's revenue and their money to do as they saw fit. So prior to 1913, you're like, well, how did we even survive back then? The way that it works is really the states were in much more control at that point for like the first half of American history. And then where the U.S. federal government stepped in, which was much, much smaller. I mean, not even a fraction of what it was today. We did not have all these welfare programs. There's no Medicare, Medicaid, Social Security, things of that nature did not exist. The US military was nothing, obviously, compared to what it is today. But there was a federal government and there was some services at the time. Up until 1913, so from 1776, our country's founding, all the way up until 1913, there were tariffs, which we've all become familiar with in the past few years, in which we levied a tax on our trading partners on imports and exports. There were tariffs going both ways, and that was for international trade. And then there were what were called excise taxes, and that was particularly on alcohol and tobacco. So that was pretty much it. That's how the federal government got by. Again, it was a much, much smaller version of what we know today. Then in 1913, the federal government began running some deficits. It was growing. They needed more stable revenue. Tariffs were very unpredictable, and it would hurt trade in some instances. So they said, okay, now it's our turn to kind of copy what the states have done in some scenarios and create a federal income tax. That was in 1913. And at that time, the top marginal rate was 7%. Okay. Now, this is something that we'll talk about in a moment, is not everybody pays tax and not everybody pays that top tax. Okay. It was almost like in 1913, they were tiptoeing their way into this new tax pool, if you will. At that time, very, very few Americans actually paid any income tax at all. Now, it was, again, not as regulated as what we would think of today, especially when we talk about, a census and what are the companies and the individuals that are in the country. We were small still, relatively speaking. So we were just going after the biggest earners, and that 7% number that I'm quoting, that was levied on a tiny sliver of America. It's estimated that less than 0.01% of Americans paid the 7% tax rate. Just to give you an idea, that was a tax that was on income roughly of $500,000 and above. If we were to build inflation into that and bring it up to $2026, that would be an income north of about $15 million a year. So at that time in 1913, the economy was much, much smaller. Very few people were obviously making that type of money. And so very few people paid that top 7% tax rate. That's how it all began, guys. That was the introduction of federal income tax. It changed pretty quickly. And this was something we thought would kind of be an experiment, but obviously it stayed. So the first big adjustment was with World War I, which we'll get into in a moment, that first kind of tax hike. But then there were a number of tax hikes. And just to summarize, it brought us to an all-time high in World War II of 94%. That was the highest marginal tax rate that we have ever had in our country, 94%. Then if we want to fast forward all the way to today, 2026, as I'm airing this episode, we now have a top tax rate of 37%. So my point of that is, if you look at this kind of historical roller coaster that is U.S. tax, it's all over the place, guys, and it's not very predictable. And that's something that we need to think about when we're trying to create plans for ourselves, where there are so many other variables, taxation just being one of them. So what I'm going to do today, I'm going to take you through a short history, an abbreviated history of some of the major events in U.S. tax history. And I think, again, everybody should be familiar with this, because not only is it a good history of our country and the things that we've gone through as a country, but also what's happened to the economy, and then ultimately what's going to happen to you in the dollars that you earn. So we create the system in 1913. Then the first kind of landmark event was, like I alluded to, in 1917. It was the War Revenue Act. All right, 1917 is when we entered World War I. To finance the war, again, these were expenses we had never seen before as a country. We accumulated some debt and we needed quickly to pay that. We were not a country built on debt, not at that time. And so we raised the top tax rate from 15% overnight to 67%. I couldn't even fathom a politician mentioning that today, but that was an increase, if you don't want to do the math, of 52 percentage points overnight, okay? And again, that was primarily to fund World War I. The next big one, kind of piggybacking on that, was the War Revenue Act of 1918, which took that even higher, another 10 percentage points from 67% to 77%. So just think about that decade. Leading up to 1913, there's no such thing as income tax. 1913, we bring it about 7%, the highest rate. And then by the time we hit 1918, just 5 years later, it's now 77%. So quite a time to be alive. You think it's crazy right now? Maybe the 19 teens were even crazier. Then we fast forward a bit. All right. We have the Revenue Act of 1932. If you're not a history buff, that was right in the depths of the Great Depression. All right. We needed to balance the budget. Even the federal revenue went down dramatically, as the entire economy went into free fall. And the government said, even in this economic contraction, we are going to raise taxes. It's really our only shot at balancing the budget. That's how important a balanced budget was at that point. The economy was in a free fall. And for anyone that knows economics, usually the last thing you would want to do when the economy is crumbling is raise taxes. That's kind of like digging yourself further when you're talking about trying to give a jolt to the economy. But it did increase Fed revenues. It got the job done. That was in 1932. They raised the tax rate from 25% up to 63%. You might be saying real quick, wait, I thought it was just at 77% in World War I. You're right, but then quickly after World War I, we cut taxes dramatically. That led to the Roaring '20s, and then we ran into the Great Depression, and now we hike taxes from 25 to 63. So you're already seeing in just this early years of this tax experiment, the volatility that our government's kind of playing with this lever. Then we fast forward a little bit further. In 1944, we have the Revenue Act of 1944. Of course, we all know that was near the conclusion of World War II, the bloodiest and most expensive war in world history. And we had to raise income taxes from 79% all the way to 94%. That was the highest in U.S. history, the highest rate ever. Now, again, not everybody was paying 94%. That was really impacting the highest earners in our country, more so than it was when income tax debuted in 1913, but still just kind of like a small sliver of America. Then let's kind of fast forward even further to more of the modern era. We come out of World War II. We have the 50s, the 60s, et cetera, a lot of rebuilding, kind of the golden age of America of sorts, where America became really the predominant superpower across from the Soviet Union. We were the capitalist version, if you will. And then in 1981, there's the Tax Reform Act of 1981. This was with President Ronald Reagan. And he wanted a pro-growth and incentive-based policy. This was one of the biggest changes in our country's history, where tax cuts went from 70% down to 50%. That's a reduction of 20 percentage points. And that's also known as the Economic Recovery Tax Act. And that did give a huge boost to the economy throughout the 80s. Ronald Reagan furthered that in 1986 with another tax cut, dropping it from 50% to a top rate of 28%. And his theory at this time now was to broaden the base and cut the rates. So he wanted to lower those top rates, and let's have much more of America having skin in the game and paying taxes across the board. And by many economists or tax experts' standards, they say that at this point in 1986, this was the simplest that our tax code was. There was really just kind of two rates that, by and large, most Americans fell into either bracket. And it removed a lot of the loopholes that had existed previously and really tried to make it as black and white as possible. And again, that was the Tax Reform Act of 1986. What happened at that same time, and you can read a lot about this, is in the 80s, yes, the economy grew dramatically. Taxes were cut significantly. The other thing that happened alongside this was spending went up by a large amount. And so then we roll into the 90s, and in 1993, there was the OBRA, the Omnibus Budget Reconciliation Act. That was during President Clinton's presidency. And the first step was the top rate went from 31% up to 39.6%. All right. Clinton came into office and faced the largest federal deficits in U.S. history. And, he said, we're going to raise taxes and try and address this, try and balance the budget. And he was successful in balancing the budget. And fortunately, there was also a lot of growth in the economy at that time, thanks to the tech boom. So again, usually you see a hike in taxes, and that's a real kind of dagger to the economy. But at the same time, we had just such an enormous tech boom as we started to get introduced to companies like Microsoft, and they all were able to give a boost opposite the tax cuts to really carry forward the economy. That was in 1933. All right, and we're rounding out the history here. As you can tell, we're getting close to modern day. Then in 2001 and in 2003, you have the Economic Growth and Tax Relief Reconciliation Act. This was during the Bush presidency. And what this did, it really boosted the economy after the dot-com bubble and the recession following 9/11. Then in 2012, again, a new presidency. You could see we're going back and forth, red and blue, or left and right. And this was during the Obama presidency that he passed the American Taxpayer Relief Act, raising the top federal rate from 35% to 39.6%. Then the most recent one, perhaps in 2017, under Trump during his first term, he had the Tax Cuts and Jobs Act, and that reduced the top federal rate from 39.6 to 37%. And that's where we are today. Whew, so that was a long, hopefully not too long, but we summarized over a century there of our tax history to get from 1913 all the way up to 2026. Couple things before I get into the bonus material that I do want to share. So one thing I mentioned, not everybody's paying that top rate. All right. If you're watching the episode today and you're seeing the charts that I'm putting up on the screen, again, I'd really encourage to go back and watch if you want to learn more about this. I think the picture's worth 1,000 words. It can be very helpful, but not everybody's paying that top rate. In 1913, I mentioned it was less than 0.01%. In World War II, when we had the all-time high of 94%, it was estimated that about 0.02% of taxpayers actually paid that top rate. And then today in 2026, it's about 1% of earners who are paying that top 37% rate. Along the way, another thing that we have to kind of make note of too is there's a whole host of statutory credits, refunds, surtaxes. Like today we have the Medicare tax, effective rate ceilings. So when we see that really long history over 100 years, there's more than just that top line number. There's a lot of other factors that can manipulate what people actually paid as far as their tax liability. And that's another distinction that I just want to share, because I see people, some very smart clients, still kind of get stuck on this, that they think their marginal tax rate is all that they pay. Your marginal tax rate and your effective tax rate are two different numbers. Your effective tax rate is the amount versus the total income that you earned, the amount of tax that you would have paid across all of those dollars. That's the effective rate. The marginal rate is just what you pay on those last or top dollars of earnings. So for instance, and I know I'm sharing a lot of numbers today, but if you can maybe even rewind when necessary, today there's a $16,100 standard deduction. So that's where people say, oh, well, the first $16,000 I make, it's essentially tax-free. By and large, that's true, because everybody is entitled to that standard deduction, where you take the money that you earn and before you do anything, you just subtract $16,100. All right. That's what your tax preparer or your accountant's doing, unless you're itemizing, which kind of puts you into another path. But after your standard deduction, from $0 to $12,400, you pay a 10% tax. This is if you're filing single, by the way. From $12,401 to $50,400, it's 12%. From $50,000 to $150,000, it's 22%. From $105,000 to $201,000, it's 24%. From $201,000 to $256,000, it's 32%. And then from 236 to 640 is 35%. And then anything over 640 would then get taxed at 37%. So naturally, it's not like if I make just $1 over 640, all my money is getting taxed at 37%. That is false. Your dollars are getting taxed like any other earner in each of those tranches, if you will, along the way. And then it's only those dollars that have eclipsed that next bracket that get taxed at that higher rate. So really understand that difference between marginal tax and effective tax, because I see so much confusion with that. All right, so I hope that was helpful, seeing a little bit of our history. And just to put a bow on it, you're saying, all right, well, that was informative. Maybe I know a little bit more about economics. I understand why our government wants money for all these different programs and everything else. But what does it mean to you in your taxes? Let's go back to the Roth conversation. All right, so the Roth IRA, or individual retirement account, is essentially the opposite of how everybody used to fund their retirement plans, which was they got a tax deduction, the money went in there, and then it grew tax deferred. And so I would always tell people that's not a tax savings, that's just a tax postponement. Because what you're doing is saying, I'm going to kind of kick the can down the road. I won't pay my tax today. I'll defer it. And then eventually, when I'm going to withdraw that money, typically in retirement, now I'm going to pay ordinary income tax on every dollar coming out of there. The Roth, when this was introduced, it's essentially the exact opposite. It says, all right, I'll pay income tax on the dollars I earn today. Then my money goes into that account, and now it can grow tax-free the rest of my life. And in the future, when I want to withdraw from it, no matter what that money grew to, it's all tax-free. And that's the beauty of it. Now, there are some caveats to that. To be what's called a qualified distribution or a qualified withdrawal, you need to be over 59 and a half, and you need to have had that Roth IRA for at least 5 years. So can everybody do it? It's a question I get a lot. Again, if we just hone in on the single tax filers, once you make over $153,000 a year, your adjusted gross income, you'll start to be phased out. Now, there are different things you could do. If you have a plan at work, a Roth 401k, a Roth 403b, the Roth TSP, etc., there's no income cap there. You can still fund it and get that same tax benefit. Or you may have heard in prior episodes I've done about the backdoor Roth IRA, which is just a two-step process for folks to fund their Roth IRA if they were over that income threshold. So why are Roths so effective? Why do you hear me or maybe some other advisors talk about it? Again, tax-free growth, all right? Getting compounding tax-free growth is invaluable, especially if we go back and we look at that tax chart that I just referenced, and you're saying, man, this thing's all over the map. It was really low, then it was 94%, then it got low again, then it got up to almost 40%. And now here we are today at 37, plus maybe Medicare surtaxes and the like. I don't want to bother with that. I want to flatten my bill today and be home free. That's where the Roth can come into play. Some other cool factors. There's no RMDs. There are no required minimum distributions on your Roth accounts. That can give you a lot of flexibility in retirement as far as how you actually want to draw on these vehicles. There's flexible contributions and withdrawals. All right, you don't have to put in the max every year. You could put in varying amounts year to year. So it does give you a lot of flexibility along the way. And then when you talk about legacy planning, your heirs or your beneficiaries, they receive the Roth IRAs income tax free. So that's something that's really effective if you're trying to leave a legacy. And now with a 10-year spend down that's subject to most retirement plans, where if your kids or your grandkids or whomever, they receive your proceeds and they're in the peak earning years of their lives, it could be a tax nightmare for them. The Roth IRA will not provide that obstacle. And so that's just one more benefit there. So it gives you a lot of tax diversification, like what I do with my clients, what we call tax arbitrage, where throughout retirement, we can pick and choose which of these buckets we want to access to create a favorable tax return for those clients. But that planning needs to be done ahead of time. That's where the real value comes into play. So that was a little bit of a bonus commentary on the Roth. And what I'll leave you with, when you kind of think about these things from such a broad standpoint of history, let's just kind of shorten maybe that time frame to the turn of the millennium. All right. So when we, year 2000, up to today, 2026, about a quarter century, one of the things that when I talk about tax history a lot, you'll see the biggest tax hikes, they were usually related to wars, World War I, World War II, things like that. That's where we saw the highest tax rates ever. And it was because we were afraid of debt. As most of you probably know, that seems to be something we've now baked into just the American way, is not just saying we'll pay for it with taxes, but we'll finance it through debt. And the costliest war I mentioned from, if we were to look at, just a short time frame of World War II, both in lives lost and how much was paid in that time, that's arguably the most expensive. But in a cumulative, the most expensive war ever was the War on Terror, which, essentially went from 2001 all the way up to just a few years ago. During that entire time, usually we didn't have tax hikes. We actually had more tax cuts in that time frame. And if we look at, in 2000, our national debt was about 5.7 trillion. Today in 2026, it's now 39 trillion. That's a factor of 6. Our national debt has increased 6-fold since 2000. So if you're thinking about, well, what if we have somebody that wants to balance the budget again, and they want to do it through income tax, like we saw so much over the past 100 years? Again, something that we want to think about when we do our tax planning. Some other factors, if you just want to kind of tie an economic bow on it, the S&P 500 in 2000 was about 1552. That was its high watermark that year. Today, it's trading at 7,173. All right, so that's actually kind of moved almost in tandem with our national debt. However, our GDP, our gross domestic product here in the U.S., in the year 2000, it was 10.25 trillion. Today, it's 32 trillion. All right, so that's gone up about 3x, where if we look at our debt, has increased at a rate of, more than 2 times that speed. So all of these guys are factors that can affect your tax history moving forward, and ultimately your dollars and how much of it you keep versus what Uncle Sam takes. And so please get familiar with these things. I hope this was a informative monologue on U.S. tax history. And I hope it gives you some maybe further thought on, how am I investing my money? What am I doing with everything that I earn? And how is Uncle Sam going to affect it? That's why we talk about things like the Roth, post-tax accounts to complement pre-tax accounts, trust and estate planning, life insurance, and income tax-free benefits. Different things like that over a very long span can give you almost an unfair advantage versus those that are more reactionary and just getting hit with taxes as the government decides to adjust that chart. All right, I hope this was helpful, guys. And if you want to learn more, please go check out my books. The economic one is What Should I Do With My Money? That came out a few years ago. And then my brand new book is Simply Wealthy. That is truly your financial plan. It's what I'm dealing with every day with my clients. So if you want something simple and easy to read manual with your own money, Simply Wealthy, go check it out. Now available wherever books are sold. That was my shameless plug. I'm Bryan Kuderna. This was another episode of the Kuderna Podcast. I can't wait to see you next time.
This podcast is intended for the general public and for informational purposes only. The show does not provide any recommendations or investment advice regarding any specific account type, service, strategy, or product, or to otherwise act in any fiduciary or other capacity. Please contact a financial professional for guidance and information that is specific to your situation. Bryan Kuderna does not provide tax or legal advice. Please contact your accountant or legal advisor to discuss your situation. Guest speakers and their firms are not affiliated with or endorsed by Park Avenue Securities, Guardian, or Kuderna Financial Team, and opinions stated are their own. All investments contain risk and may lose value. Past performance is not a guarantee of future results. References to specific securities, asset classes, and financial markets are for illustrative purposes only and do not constitute a solicitation, offer, or recommendation to purchase or sell a security. Bryan Kuderna is a registered representative and financial advisor of Park Avenue Securities, LLC, PAS. OSJ 300 Broadacres Drive, Suite 175, Bloomfield, New Jersey 07003. Phone number 973-244-4420. Securities products and advisory services offered through PAS, member FINRA SIPC. Financial representative of the Guardian Life Insurance Company of America, Guardian, New York, New York. PAS is a wholly owned subsidiary of Guardian. Kuderna Financial Team is not an affiliate or subsidiary of PAS or Guardian. California Insurance License Number 0K04194.